Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So our mission today is to really cut through the noise. We're looking at sources that reveal two major financial shifts happening right now. And these are just, minor market results. These are fundamental changes in how we should be thinking about valuing companies and managing global portfolios.
That's absolutely right. It's like two separate, huge tectonic plates are moving under our feet.
Exactly.
And if the inputs change this drastically, your strategy has to adapt just as fast. The first plate we're looking at is what we're calling big tech's identity crisis.
An identity crisis.
Yeah. We're tracking how the world's biggest tech companies are being forced to spend capital like they're, old school utility or infrastructure providers.
And the risk there is huge, right?
Yes.
The utilities don't get those sexy premium valuations that platform companies always have.
Not at all. And then the second shift is this curious currency disconnect. It's a global thing, but we're seeing it really clearly in markets like, say, the Korean one, where a strong stock market rally, which should be a sign of strength, is completely unmatched by the currency's performance.
It feels like the traditional rules are just breaking down.
They are. And the overarching goal here for you is to understand how these two shifts change the way we calculate risk, capital efficiency, and how we manage money across borders. We need to find where the hidden costs are landing.
Okay, let's unpack this. Let's start with the biggest companies in the world. For, the last 2 decades, the core reason big tech had those truly astronomical valuations was the asset-light model.
Exactly. The classic big tech playbook was all about high capital efficiency. They had this incredible ROIC, return on invested capital.
Right.
Meaning they got huge profits without sinking billions into factories or, heavy physical assets.
Think about Apple. It's the classic example in our sources. They focused on brilliant design, their ecosystem, and just pure brand dominance.
And they outsourced all the messy manufacturing stuff.
Exactly. Because they weren't carrying this massive, tangible asset burden, their balance sheets looked incredible, and their earnings were pretty stable, even in a downturn. They were selling ideas, not physical stuff.
But here's where it gets really interesting. The recent analysis we've seen shows the intense AI competition has it's completely changed the game.
Oh.
The bottleneck has shifted. It's not just about clever software or algorithms anymore. The real constraint now is physical resources.
Physical resources? You mean like...
I'm talking compute power, massive amounts of electricity, building gigantic data centers, and locking down the entire semiconductor supply chain.
So the company that could once design a killer app in a garage now has to go out and build its own power grid just to run it.
That's pretty much it. And
Yeah.
the implication is profound. Big tech is now facing a manufacturing-type logic. They need massive scale, which always means high fixed costs, huge depreciation charges every single year, and these intense ongoing maintenance burdens. The analysis suggests the market might have to start pricing them as super large infrastructure operators.
Not platform companies.
Free north?
That just sounds incredibly expensive. I mean, what is the scale of this financial burden? Because if you're going from asset light to asset heavy, that has to show up as debt.
And it is showing up as massive borrowing. Reuters is reporting that the hyperscalers, your Amazons, Googles, Metas, Microsofts, they are all significantly increasing their corporate bond borrowing.
Just to fund this build-out.
Just for the AI infrastructure. The projection for 2025 bond issuance is expected to blow past historical averages. They're going deep into debt to build this new reality.
And the commitment they're making is just staggering. I saw one example that floored me from AP News. Meta is actively trying to get up to 6.6 gigawatts of nuclear power for its data centers.
6.6 gigawatts.
To put that in context, that's enough to power several mid-sized American cities. It's like they're trying to become a small country just to keep their AI running.
In that example, it just highlights how the investment has moved beyond buying servers. Now it's about long-term locking in power infrastructure.
And that's what changes the whole financial model.
That's it. Once your capital expenditure, your CAPEX, reaches this kind of irreversible scale, those long-term cost depreciation, maintenance, they make the whole investment cycle almost impossible to stop. You can't just pause a nuclear power contract.
So, on one hand, this is a gigantic financial burden.
Yeah.
But is everyone panicked? Or is this seen as a smart move to guarantee dominance?
Well, this is where it gets fun. We are seeing a fascinating split in expert opinion.
Okay.
The first camp, they're championing what they call the moat argument. I was reading the Financial Times on this, and they reported that this massive CAPEX, yes, it's unavoidable, but it actually strengthens the winner-takes-all moat.
Ah, so it's like paying the price of admission to a kingdom only the wealthiest can even enter.
Precisely. If power and computing are the real bottlenecks, then whoever scales first gets this huge competitive edge. More scale means more data, faster learning, quicker products, and ultimately a lower cost per unit.
I see.
The FT even noted that securing long-term power, maybe even things like small modular reactors, those are basically smaller, cheaper nuclear plants, is now a critical competitive advantage. Scale is the moat.
But I'm guessing not everyone is buying that story.
Not even close. And then you have the other side, the overinvestment warning. Analysts cited by Barron's are raising the alarm here.
Yeah, they're saying.
They're saying this aggressive CAPEX is starting to strain the credit market, and it might be repeating a classic pattern we've seen before. Investment excess leading to profit deterioration.
We have seen that movie before. The fiber optic boom in the 90s, the fracking boom.
Exactly that. Fortune, citing Goldman Sachs, is suggesting a similar skepticism. The big question is whether the market is just overconfident that future AI monetization will be big enough to justify the spending now. If the returns aren't there, the debt is just dead weight.
So this all leads to the ultimate question for an investor. What does this do to the stock price? What happens when you have slow revenue growth plus huge fixed costs?
And that combination leads to the big one, the valuation penalty. The increase in fixed costs in borrowing, it makes future earnings far less predictable.
I see. So if you're asset light, a dip in sales is, manageable. But if you're asset heavy,
that dip gets magnified. That's the core of the predictability problem.
so the risk isn't just debt. It's that their entire P&L statement now has a much lower tolerance for error.
That is the problem. If big tech earnings start moving with the leveraged volatility of a steel company instead of the smooth path of a service company, the market reaction is clear. It assigns a significantly lower multiple valuation penalty. And that could erase years of stock gains very, very quickly. That's the tension.
That is a fundamental paradigm shift.
Yeah.
Okay, so we've covered the shift in big tech capital. Now, let's zoom out because the way capital moves internationally is also changing. We need to talk about this currency divergence happening in Asia.
This is a completely different set of worries, but just as critical for a global investor. We're seeing this strained, persistent disconnect, especially with a currency like the Korean one.
Right.
It was recently moving near its 2016 or 2017 low, even as the local stock market was doing quite well. You have stocks signaling growth and the currency signaling risk.
A complete decoupling.
Yeah.
It just defies the basic assumption that a strong economy means a strong currency. Why is this happening? Let's start with cause number one.
Well, the primary driver, according to Reuters, isn't actually in Asia. It's rooted in how the market is readjusting its view on the U.S. Federal Reserve's rate cut path.
The market finally woke up and realized the Fed wasn't going to cut rates as fast or as deep as everyone hoped?
Correct. So U.S. interest rates stay higher for longer. That shift just solidified dollar strength, or at the very least, it delayed that great dollar reversal everyone was waiting for. And a strong dollar puts pressure on almost every other currency. It's like gravity.
Okay, so that's the U.S. side. What about the local dynamics in Asia? Cause number two.
It's the widening rate differentials that result from that. While the U.S. is slowing its pace of expected cuts, several big Asian central banks have either already eased their rates or are leaning that way.
So they need to simulate their own economies.
Right. So you get this widening gap. U.S. rates are high, while the Bank of Korea, for example, has less room to move and might even need to cut rates down the line.
And capital just follows the higher yield.
Always. That gap makes investing in U.S. dollar assets more attractive, which burden of local currencies. Reuters noted this was a clear factor in the Bank of Korea's decision to freeze rates recently. They had to prioritize financial stability over stimulating the economy. They're caught.
And finally, cause number three, which seems like the most stubborn one, structural dollar demand. This isn't just about hot money in the stock market.
No, this is much deeper. Bloomberg and Reuters highlight that this is about large, ongoing, non-negotiable economic needs.
Like what?
Like domestic investors moving funds overseas for diversification, and this is critical, the structural need to pay for huge amounts of raw materials, energy, and components in U.S. dollars.
That makes perfect sense. So even if a huge company has a record quarter, if they need to buy oil or microchip equipment from abroad, they are forced buyers of USD.
Exactly. And that constant structural demand for the dollar acts like a drain, limiting the local currency's ability to strengthen no matter how great the stock market looks.
And there's evidence for this, right? It's not just a theory.
There is. A really useful comparison from our sources is the case of Japan. Reuters pointed out that the Japanese yen-dollar pair was remarkably stable for a while, even when there was high volatility in Japanese government bond yields.
That's a key clue. If the bond market, which is super sensitive to rate expectations, is going wild, but the currency is stable.
It proves the currency isn't just moving on local interest rates. It proves that these deeper structural flows and global expectations for the U.S. can override local signals.
So, given all these deep-rooted factors, what does this mean for someone investing in high-growth Asian stocks? Can we just wait for an automatic reversion when the Fed finally cuts?
Well, financial authorities, like Korea's Treasury, they've given some verbal warnings. They might intervene.
But that can only do so much.
Right, they can put a speed bump on the descent, but they can't reverse the main drivers. So I would strongly advise against assuming an automatic reversion.
So what's the move then?
The most important action here is to reevaluate hedging.
Hedging. So actively protecting your stock gains from being eaten away by a falling currency.
That's right. Bloomberg suggests that when global volatility is high and hedging costs are relatively low, like now, it's a crucial window to do it. If currency risk can wipe out 15% of your 20% stock market return, you have to manage that actively.
So the recommendation is rule-based, partial hedging.
Yes. Something like hedging between, say, 30% and 70% of your assets could significantly improve your risk-return profile. You have to stop seeing currency as a passive side effect and start managing it as an active risk. The old rules have broken down.
This was a dense dive, but two huge takeaways really stand out. First, big tech's premium valuation is under threat because their success now depends on capital efficiency, not just growth. They become infrastructure companies.
And second, if you're investing in high-growth Asian markets, you have to actively manage and hedge the currency component. You can't just assume a strong stock market will give you a strong currency anymore.
So if we look at that big tech shift one last time, they're all spending these incredible amounts of capital. What's the ultimate differentiator? What separates the winners from the losers in this new heavy CAPEX world?
It won't be the sheer size of the CAPEX. Everyone's building big. The real differentiator will be the recovery method.
The recovery method.
Yeah. Success will hinge on how effectively they link that massive investment, their power contracts, their data centers, to their actual utilization rates, internal productivity, and finally, the external pricing of the AI services they sell.
So it's about connecting the spending to the earning directly.
Perfectly. If that entire chain is optimized and efficient, the CAPEX becomes a powerful moat. But if that linkage is weak, the capital-intensive model becomes a long-term liability and a valuation penalty. That operational linkage is the single key metric to watch.
That's a fascinating way to think about what makes a $2 trillion company run well, something to keep a very close eye on. Don't forget to subscribe and hit that like button.